Welcome back to the Deep Dive.
Great to be here.
So today we're diving into T1 Energy's first quarter 2025 earnings call transcript.
Yep, lots to unpack.
Our mission, as always, is to cut through the noise, pull out the key takeaways. We'll look at their progress, the policy landscape, financials, basically get you up to speed fast on what T1's up to.
Okay, let's do it. So stepping back, there are really two big themes that kind of jump out from the call: progress and policy.
Yeah, and interestingly, the policy stuff is really impacting their, near-term progress quite a bit.
Definitely. You see that straight away.
Absolutely. I mean, the big news wasn't just the Q1 revenue, which came in at $64.4 million, mostly from that Trina deal.
Right, the cost-plus contract.
Exactly.
Okay.
But the real headline was the revision to their full year 2025 guidance. They cut production and EBITDA outlooks.
And they spent a lot of time on the call linking that uncertainty directly back to the policy environment.
They did. They focused heavily on these proposed changes from the House Ways and Means Committee, specifically around the IRA energy tax provisions.
Right, the Inflation Reduction Act. And what's interesting is their take on it, their initial assessment. Some parts actually validate their whole strategy.
Yeah, things like keeping the 45X manufacturing credit and the domestic content bonus. They see those as like fundamental building blocks for a U.S. solar supply chain.
Okay, so that's the validation part. But they also flagged some concerns, didn't they?
They did. Worries that other proposed bits could, maybe stifle competition, slow down growth, make it harder to bring tech manufacturing onshore.
And limit customer choices in the end.
Precisely. A key example they highlighted was this proposed stringent foreign entity of concern language.
Ah, the FEOC rules. That hits close to home for them because of their partnership with Trina, right?
Exactly. They made it clear they're ready to adjust their business plan if they have to stay compliant and make sure they can still access those IRA incentives.
Smart move. And they're not just waiting around. They mentioned they're talking to lawmakers, local, state, federal, pushing their case.
Highlighting their U.S. investments, the jobs they're creating. Makes sense.
And it's important to remember this is just the first step in what could be a long legislative process. They sounded hopeful that, practical changes might happen later on to avoid too much disruption.
And T1 feels they've got a strong voice here, given their investments.
To help navigate all this, they brought in some serious firepower. Andy Monroe, the new chief legal and policy officer.
Oh, yeah, I saw that. His background is super relevant, isn't it? Something about shaping the 45X framework.
Exactly, at a previous company. So, yeah, clearly a strategic hire for these times.
Okay, so that's the legislative side. What about trade policy? Tariffs? AD/CVD?
They touched on that, too. Generally, T1 supports tariffs that level the playing field, the kind that reward domestic producers like them who are investing heavily in the U.S.
Which they are, right? Sourcing polysilicon here, planning that integrated footprint.
Correct. But even supporting the idea of tariffs, they admitted the uncertainty around them right now is causing near-term headwinds. It makes it hard to get visibility into their bill of materials costs. And that's crucial when you're trying to bid on big long-term contracts like offtake agreements or PPAs. You need to know your costs.
Right. And that lack of visibility, that connects back to the guidance cut.
Directly. They explicitly said they decided to lower the 2025 outlook for sales, production, and EBITDA because they're assuming very limited merchant sales this year while they wait for more clarity on tariffs.
Okay, this is where it gets really interesting, though. Because despite cutting guidance based on that merchant sales caution.
They already have 1.7 gigawatts locked in. An offtake for 2025.
Exactly. These aren't just hopes. They're secured contracts. So revenue and cash flow are still expected to ramp up significantly in the second half of the year.
Meaning they expect to end 2025 with a pretty strong cash and liquidity position, even after paying down some debt.
Yeah, that was a key point they made.
Zooming out a bit, management also stressed that the basic fundamentals for U.S. solar are still healthy, still supportive of their overall strategy.
They pointed to solar and storage being the fastest, most cost-effective ways to add capacity.
Especially with growing energy demand from AI, electrification, the manufacturing comeback.
It makes solar and storage pretty critical.
They even framed their strategy explicitly around what they called President Trump's key priorities, strategic U.S. supply chains, bringing manufacturing back, American jobs.
Interesting positioning there, reflecting their view from the call. Okay, let's shift from policy to actual operations. G1 Dallas.
Right, the launch pad. They said Q1 saw good momentum, and the facility is now fully operational. Handover was late April.
And importantly, that construction loan got converted to a $235 million term loan that's after third-party verification, basically confirming the plant's ready to go.
Big milestone. And sales are ramping up based on those 1.7 gigawatts of contract.
Deliveries started Q1 for Trina, Q2 for RWE.
That's the 500 megawatt per year deal.
Right. And they expect shipments for a new developer agreement to start in Q3.
And they announced that specific new deal too, 253 megawatts for 2025 for a Texas project.
Deliveries starting Q3. And they mentioned this deal helps support their decision to switch some lines over.
Yeah, converting 3 production lines at G1 from PARC to Tapion technology.
Which aligns with where the market's heading, right?
Yeah.
And shows they can be flexible.
Exactly. But speaking of production, they did lower the 2025 plan for G1 Dallas down to 2.63 gigawatts from 3.4 before.
Why is that?
2 main reasons given. First, that lower sales outlook because of the market uncertainty tariffs again, and also just integrating the Trina sales team takes time.
Okay. And the second reason?
That elective conversion of the 3 lines to Tapion. But they were really clear. The facility can run at 5 gigawatts. The loan conversion proves it's capable.
So the lower production target isn't a capability issue.
No, they framed it as a strategic sales-driven choice. They don't want to overproduce and sit on inventory if the market's uncertain, especially on pricing for those merchant sales.
Got it. So with 1.7 GW booked, they'll look at other merchant deals.
But selectively, only if the margins look good. And critically, they said they're not willing to take on the full tariff risk themselves, which some customers apparently asked for.
Okay, so the picture for G1 Dallas is built, verified, capable, starting deliveries on contracts. But policy caution is keeping them from running full tilt for now.
That sums it up well.
So what's next? G2 Austin. That seems to be where the long-term excitement lies.
Definitely. Their planned U.S. solar cell manufacturing facility in Malum County, Texas. Management kept calling it a game changer.
Competitively and financially.
The logic is pretty clear. It's meant to meet this big customer demand for U.S.-made cells and modules using that high-efficiency Tapion tech.
And it's a huge step for their domestic content strategy, right? Vertical integration.
Absolutely. They see it as a future cash flow engine.
How are they planning to build it out?
In 2 phases, each about 2.4 gigawatts of equivalent capacity. Gives them flexibility commercially, financially, operationally.
And where are they with development?
Initial engineering is happening. They've kicked off the bidding process with equipment vendors. And importantly, the money side, capital formation, is moving forward too.
Any specifics on funding?
Yeah, they announced a non-binding heads of agreement. It's with a third-party partner linked to Saudi Arabia.
Interesting. To explore a potential minority investment.
Exactly. Potentially into both G1 and G2 assets. Still early days, non-binding, but they said the reception has been positive. Sounds quite strategic.
And the timeline for G2 Austin starting production?
Still targeting Q4 2026. This project is really the linchpin for their whole domestic content roadmap.
They want a fully integrated U.S. supply chain, right? Aiming for over 70% domestic content by 2027.
Yeah, not just modules, but polysilicon, ingots, wafers, cells, the whole shebang made here.
And the benefit of that, besides just made in USA?
It ties back to policy again. It aligns them with potentially stricter IRA rules, like that FEOC language.
And helps their customers qualify for those domestic content bonus tax credits, the 48E stackers.
Exactly, which boosts the project returns for the developers using T1 modules. Plus, customers just want more secure, traceable supply chains these days, less risk from tariffs, duties, detentions.
So the goal is modules with great LCOE levelized cost of energy and high domestic content. Win-win for their clients.
That's the pitch. So connecting the dots, G2 is the crucial next play in their long game. Vertical integration, capitalizing on domestic incentives. That strategy seems solid, even with the near-term G1 bumps caused by policy static.
Okay, let's circle back to the financials. We mentioned the Q1 revenue, $64.4 million, but the big story was that revised 2025 guidance.
Yeah, production down to 2.63 GW for G1, and EBITDA guidance cut to $50 million from $125 million previously.
Matching that lower sales outlook, around 1.7 to 2.3 GW.
Management gave 4 key points to put that revised outlook in context, which I think are important.
Okay, what were they?
First, they really hammered home that their cash and liquidity position is strong, and they expect it to improve. They're projecting over $100 billion in cash liquidity by year-end 2025.
Even at the low end of the new EBITDA guidance.
Yes, and that projection includes making a $71 million debt and debt service payment by then.
Okay, point one. Liquidity strong. What's 2?
Significant operating leverage. They pointed out that even at the low end of the revised EBITDA range, G1 is only running at about 30% capacity.
30%. Wow.
Yeah, but even that rate is expected to generate around $25 million in EBITDA, enough to cover G&A.
Including those European wind-down costs that go away in 2026.
Right, and fully cover their debt service.
Yeah.
So they see huge potential for profit expansion once they can ramp up production closer to full capacity when the market allows.
Makes sense. Point 3.
They framed the decision to lower guidance as prudent, basically avoiding locking in potentially low-priced merchant sales right now because of all the uncertainty around tariffs and component costs.
They don't want to take the tariff risk or just dump inventory cheap.
Exactly. And point 4.
What's the last one?
The prize, as they called it, is beyond 2025. The long-term focus hasn't changed. Execute the U.S. vertical integration plan with G1 plus G2.
And that integrated G1, G2 annual EBITDA target
Still stands at $650–700 million run rate, unchanged. They believe the demand for domestic content is only growing, backing up that long-term view.
Okay, so near-term caution, long-term confidence. What else on the financials? Balance sheet?
They did use some cash in Q1, but they don't expect that to continue. As G1 sales ramp up with those secured contracts, operating cash flows should improve.
And they expect cash from those 45X tax credits soon.
Yeah, monetization expected in Q2 or Q3 this year. That'll help liquidity too.
Plus the savings from winding down the old European operations.
Accelerating later this year, fully going in 2026.
And they also hinted at potentially selling off some legacy assets. Giga Arctic, CTP, Gigavasa.
Right, and any cash from those sales would be on top of that projected $100 million plus year-end liquidity, so potential upside there.
It really raises an interesting communication challenge, doesn't it? How do you tell investors, hey, we have to cut near-term guidance because of policy uncertainty?
But that same policy direction actually makes our long-term strategy even more valuable and on track. It's definitely a tricky balancing act.
So bringing this back to you, the listener, trying to understand T1's commercial approach. It seems really focused on building those strong relationships and locking in long-term deals.
Like that RWE contract. Cost plus structures, they said they're in advanced talks for similar deals with other big players, utilities, IPPs, developers.
And then what are those customers asking for?
Pretty clear priorities. They need high-efficiency 2.2 modules. They want them made in the U.S., ideally with U.S. parts. They need a reputable supplier with a traceable supply chain.
Why the focus on U.S. made and traceable?
It all comes back to enabling those developers to get the domestic content bonus tax credits, the 48 adder. That can really move the needle on project economics.
And announcing G2 actually helps these discussions.
Apparently so. They said it accelerated existing talks and sparked new interest. Shows the market wants that vertically integrated domestic vision they're selling.
So as things get clearer on trade policy, supply chains, the final IRA rules,
they expect to sign more of these big multi-year deals. They'll still look at merchant sales, but only if the margins are good. The focus is definitely on those long-term strategic partnerships.
It's just fascinating, this constant interplay between policy, strategy, and execution.
It really is. Policy uncertainty hits them short-term, forcing the guidance cut. But the direction of policy IRA, domestic focus, validates their long-term G2 plan.
Short-term pain, maybe, but it reinforces the potential long-term gain and drives that customer demand for U.S.-made products.
Management's closing remarks really hit on this duality. They believe T1 is set up to thrive in this environment. Key priorities are commercial progress, expanding the U.S. supply chain, becoming a cash flow machine.
Near term. Get G1 Dallas humming, deliver on contracts, be careful with merchant sales, build that U.S. TPOW leadership.
Long term. Advance G2 Austin. Use the cash flow from commercial activities to fund G2 development.
Okay, so quick recap. T1 Energy is navigating a really complex situation. U.S. policy and trade issues are causing near-term bumps. You see that in the lower guidance and production plans.
But fundamentally, those same policy trends are actually reinforcing the long-term value of their big bet on U.S. manufacturing and vertical integration, anchored by G1 now and G2 coming online later.
They're projecting strong liquidity even with the guidance cut, and they see a lot of operating leverage once market conditions let them ramp G1 closer to its full potential.
And that focus on domestic content is key to landing the big strategic customer deals that should drive future cash flow, especially with those IRA incentives in play.
All right, so here's a final thought for you to chew on. Management explicitly linked their strategy to U.S. political priorities. It makes you wonder, just how much does the future success of companies like T1 Energy really hinge on the stability and the specific direction of government policy and incentives like the Inflation Reduction Act? Something to mull over.
Definitely food for thought. Thanks for tuning into The Deep Dive.
We'll be back soon with another deep dive into the earnings call landscape.